I would now like to go over at problem 18-5, which utilizes the treasury stock method to reacquire their own shares. In February 15th, 21, they paid $8 per share and they purchased 300,000 shares. So 300,000 shares times 8 is $2.4 million. And treasury stock would be debited for the actual price, 300,000 times 8, which is $2.4 million. In journal entry on February year 22, they purchased the treasury stocks for $5.50. So again, they would take cash, credit cash for 300,000 times 550, which is 1,650,000, and the treasury stock would be debited for $1,650,000. Now, when they sold their reacquired shares, they sold it for $7 per share, and it was 200,000 shares using the FIFO method. So you would debit cash for 200,000 times 7, which is 1.4. However, you credit treasury stock for 200,000 times 8, which you originally paid in 2021 for $1.6 million, and you debited retained earnings for the $200,000. I will go over illustration 8-9, but prior to doing that, because I wanted to give you more information with how a company records treasury stock that is reacquired when there's a paid-in capital in excess of par for treasury stock shares repurchased and retained earnings. But I'd like to first go and calculate the treasury stock equity. And the paid-in capital and common stock remains the same because when you go through the journal entries, we never reduced the common stock or the paid-in capital in excess of par, and we never recognized the paid-in capital for shares repurchased. Now, the retained earnings will be different in that the credits would be the same, the beginning balance and the actual net income for 2021, 2022, and 2023. However, the only time we debited retained earnings under the treasury stock method is the 200,000 on 2023. So our retained earnings is $131,300. Now note that the treasury stock is a subtraction from the equity section of the 400,000 shares they have left based on their cost in treasury. The 400,000 shares left consist of the 100,000 shares that were repurchased at $8, so that would be 800,000, and the 300,000 shares purchased at $5.50 would be $1,650,000. So there would be a debit to treasury stock of $2,450,000, and notice it is a subtraction to to the equity account. And what I'd like to point out to you is the total shareholders' equity remains the same. The only difference is when you retire your shares, you reduce your common stock, your paid-in capital, or you also include paid-in capital for shares repurchased in this problem. However, for the treasury stock, you do not retire the shares by reducing common stock or paid-in capital of excess from par. you actually debit treasury stock, which is increased with a debit, decreased with a credit, and is reported in the equity section of the balance sheet. So it's just whether you retire them or use treasury stock, your stockholders' equity will remain the same. It's the presentation. I am now reviewing illustration 1811 in your textbook to review some other transactions that would need to be recorded under the treasury stock method. Now, right above illustration 18-11, we see our stockholders' equity account under the treasury stock. And when we look at the treasury stock, we see 1 million shares at cost, which is $13 million. So, under the treasury stock method, they purchased or reacquired the company's shares for $14 per share. So they received cash of $14 million. They would take off of the equity, they would actually recognize the cost I pointed out above that would be credited for the full amount of $13 million because that's the cost. And the paid in capital shares repurchased would be $1 million. Then in case B, they sold the shares for $10 million per share. So in this case, they would debit cash for $10 million. They would go above and look at paid in capital shares repurchased for treasury stock to be $2 million. So our paid in capital shares repurchased would have to be debited for $2 million. And then to balance the equation, it would have to be a debit to retained earnings for $1 million, and the treasury cost would be credited for $13 million. Under the treasury stock method, when you resell shares you acquired, you first make up the difference by eliminating the paid in capital shares repurchased. And in this case, you only had a balance of $2 million in paid in capitals repurchased. That means that in the treasury stock being credited for $13 million means you have to debit retained earnings to make up the difference of $1 million. If paid in capital shares repurchased was enough to settle the $13 million credit to treasury stock, you wouldn't have to debit retained earnings. First, when you resell your treasury stock, you will debit the cash. You would then look at the paid in capital shares repurchased, and you can use that until it becomes a zero balance, and then you would make the difference to balance your account to the treasury stock credit of at cost of $13 million. You would use retained earnings.